Okay, hello everybody. Welcome to Korean Atlanta Mentorship. Right now it's 4 a.m. my time, and I actually went to sleep, I think around 9 or 10 a.m. I was just so tired, and all of a sudden I woke up at like 2 a.m. and I figured I'd crank about a couple of videos out on YouTube before I went to sleep again. And I figured, hey, you know what? Why don't we just do another velocity banking practice video at 4 a.m.? We'll call it 4 a.m. boot camp. Okay. All right, so we're in this video, we're going to practice velocity banking and just kind of go over the basics and just create a spreadsheet because the spreadsheet's easy. I know some of you email me and say, hey, I want the spreadsheet, but really you're doing a disservice to yourself if you don't just try to create your own and do a little practice, okay? So in order to do, first of all, let's actually ask ourselves, what is velocity banking? Velocity banking is a debt payoff strategy that will allow you to quickly pay off your debts, pay less interest, and also maintain and manage your cash flow or control of your money, right? So in order to get engaged in velocity banking, we really only need two things. One of them is our budget. So this is our budget. We need that. So when we do our budget, we have to list, what's our income, what's our expenses, right? And how much cash flow do we have? Okay, actually, let's do this. Checking and savings. So let's go ahead and write down our budget. I'm going to go ahead and color code this. So income is green, expenses are red, checking and savings, we're going to make that into a neutral blue, and cash flow will make black. Okay, so I always like to use these figures. Again, your figures may differ. So there's people who make like six figures, live paycheck to paycheck, and there's people making 50 grand that are doing okay. And there's people who are at the opposite, people who are making 50 grand and paycheck to paycheck and six figures and, at the top of the world. But let's just assume that we make $5,000 a month, right? And our expenses are going to be about $3,000. Again, I always like to use the same figures over and over again. And our checking, so if we subtract income minus expenses, then our checking and savings that's left over is $2,000, and we consider this to be a zero cash flow situation. Now, some of you might be thinking, isn't this positive cash flow? I would say it depends, right? So if you just have checking and savings, but you also have debt at the same time, I mean, I've met some of you who are in the situation where you get 20 grand in the bank and then 20 grand in credit card debt, right? So if you have 20 grand in the bank and it's only growing, the interest rate on it is like 0.001%, although I've seen like 5% savings accounts nowadays, to be honest. But in general, savings accounts are known to have like 0.001% interest, and you got a credit card that's at 20 to 30% interest. Like, what are you doing, right? They're just the banks are just making money off of you, and this is why it's considered to be a zero cash flow situation because you're just putting money away and just not it's not working for you. Okay. Now, after that, now we're going to do what we call an expense breakdown from our budget. So expense breakdown, let's go ahead and make it spiffy. We're going to go ahead and highlight it, right? And we just got to make sure our expenses equal this number. And what's really important is that you're going to list every single debt that you have. Debt one, debt two, right? Rent, other things, food, gas, insurance, etc. Right? Okay. So now I'm just going to list two common debts that people have, which is a student loan and then an auto loan, right? And then you want to put some figures in there. So what's the balance of the student loan? I'll just say 10K, 10K balance. And then I'm just going to put the average monthly payment, which is 400 a month. And I'll say 6% interest rate. Same thing here with the auto loan. Let me just do this. I'll copy and paste. Auto loan, 13K balance, and I think the average auto loan is actually 800 a month nowadays. So I'm using old figures here. So I may have to kind of update these figures, but the fact that the average auto loan, I remember when I took out it like in 2015, I took out an auto loan for like and it wasn't even, it was like a lease for $400 a month, and people were like calling me an idiot. And now you look at the average auto loan is like 800 a month. Times sure have changed, right? All right, so back to this. So expense breakdown, you have to make sure that every single debt that you have is its own line item because every debt paid off is cash flow that you recover, right? And then rent and other, you can actually combine these non-debt expenses. You can combine, but I always like to put rent in its own separate category because everybody knows how much they're paying for rent, but they may not remember how much they pay for food, gas, insurance. Okay. And so let's go ahead and write down these figures. So let's just do this. Okay. So now we're gonna do 400 a month, 600 a month here. Rent, we'll say 1,000, and then other, we'll say 1,000. And so if you sum this up, right, this will equal 3,000. And you can actually use formulas, Excel formulas to do all this. So instead of just writing 3,000 directly, put income minus all the expenses, right? You can certainly do that. So let's just do a sum of these expenses. So you just do equals SUM and then do B, which is the column, and then you want to start from line 7 to 10. So B7 colon B10, right? And that will equal $3,000 if you want to do a formula. And if you want to do checking savings with the formula, then it's income, which is B1 minus B2, right? Simple formula. So if you want to do a formula rather than typing it in, you can certainly do that. Now let's go ahead and do this. I'm going to add another line here. And we're going to do velocity, I'm sorry, average American, not average America. What am I doing? Average American. So we've done the first step, which is the budget, right? Now, the second step is you select your operating account, which will be your line of credit. And so there's different types of lines of credit. I always use the personal line of credit in our examples, but this time I'm going to use the home equity line of credit. And if you don't know what a line of credit is all it is a financial tool where you can borrow money, pay it back, and use it over and over again, right? So if you have a credit card, that's exactly what it is. It's a line of credit, but there's different types. So home equity means you're, in the lending world, there's something called security and there's something called collateral. So if you're pledging something that you have in case you failed to repay the debt, that's collateral, right? And a very popular product, maybe not as popular as a mortgage, that you can use to pay off your debts or to help you pay off your debts is called the home equity line of credit. And basically you're pledging the equity of your home, kind of think of it almost like the profit of your home if you sell it, to the banks in case, and they'll give you a huge, almost a credit card like tool for that, right? So let's just do this. So we're going to create another column here called velocity banker, right? And somebody said, hey, we don't, not Americans aren't the only people in this situation where they just can't pay off debt, right? And so I'll just, instead of calling average American, I'll, just to include you here because I think Americans, bad habits start in America and they've kind of spread to the rest of the world. Or maybe they don't, and maybe I'm just making this up, but we'll call you average honorary American, just in case you're not American. All right, so let's go ahead and figure out what velocity banking tool or operating account we're going to use. So think of it as like we're writing down the details of a credit card. So interest rate, we want to figure that out. We want to figure out the available limit. We'll call this credit limit, and then we'll call this the balance, right? So usually if you use a home equity line of credit, it's like a 10% interest rate. Sometimes they'll give you like a 0.99% or a 0% interest rate in the beginning, but I'm just going to say this is a 10% interest rate. And if you use an unsecured line, like a personal line of credit that's unsecured, it's usually around 14 or 15%. It changes by daily, but it's usually 14, 15%. It's not fixed. But let's say that the banks are saying that, hey, if you click a button on a website, we'll dump 50 grand into your checking account and you borrow at a 10% interest rate. I'm like, I'm cool with that. right? And so that's the amount that we can borrow in our home equity line of credit. And let me just do that here. Home equity line of credit, or they call it a HELOC. Let's go ahead and highlight that. And so we have a HELOC here. Let me bold that here. At a 10% interest rate, and we'll be able to borrow $50,000. Now, let's do the velocity banking budget, right? So your income stays the same. All we have to do is, and let me just format this here. So this is correct. Okay, so 5,000 in income, but we're re-engineering our budget to use velocity banking and pay off our debts quickly. Okay, so let's just hold off our expenses. Now, checking and savings, we're going to put this to 0, and cash flow, we're going to also redo after we do our expenses. Okay, so now let's take a look here. We have this 10K student loan balance, and a 13K auto loan balance. So what is something that we can do to help us increase our cash flow? Well, why don't we just after we go to the HELOC website, the bank's website, click a button so that we can dump 23,000, because that's 10,000 for the student loan and 13,000 for the auto loan, into our checking account. So I'm going to go ahead and click a button, and I'll say, please, Mr. or Mrs. Bank. I don't know if that's how they speak. I'm just making it up. I'm just kidding. Please dump 23,000 into my checking account. So now we're going to have a $23,000 balance in our line of credit at a 10% interest rate. Once we do that, we're gonna pay our student auto loan off. So this is going to be 0. This is going to be 0. Now we got 0 on our checking and savings again, right? So we're certainly going to do that. But our rent is still the same, unless they raise the rent. Hopefully they don't, but though the rent's been too high for quite some time. All right, so now let's figure what's happened to our expenses. Our expenses magically went to 2,000, right? And what we're going to do is we're going to use our cash flow, 5,000 minus 2,000, to bring down our debt, which is this $23,000 here. So what's the basic strategy? Let me actually do this, make this a little bit spiffier. The strategy is you put this $5,000 paycheck into the HELOC, the line of credit, and two things are going to happen. First thing is that it's going to satisfy the minimum monthly payment. Second is it's going to put the average daily balance at the lowest it will ever be, thus decreasing the interest. Okay? And now what we're going to do is make sure that this decreases and calculate how long it's going to take to pay this off using our $3,000 cash flow. Okay, so dump our paycheck here. It's going to be 18 grand, and then eventually the expenses are going to go up 2 grand, which may be 20, right? So now every month the balance is approximately going to go down 3,000, right? And I know this is a gross simplification, but bear with me here. So it goes H2 minus 3,000. Okay, so now we do that. And so now we go all the way down to 0, right? And let's see how many months it took us. How many months? So we'll say the first month is month 0. 0, 1, 2, 3, 4, 5, 6, 7. So about 7, 8, no, actually about 8 months, right? Okay. And then now we have to calculate the interest paid. So paid interest, right? And again, some people point out, like, isn't that calculated after each month? Yes, it is, but it's easier to visualize it this way. I call it semi-accurate math. It's not totally accurate, but it's close enough. And here's the thing, if you want to be accurate, you're going to have to calculate the average daily balance, which is really impossible because how do you know what days expenses occur? So again, these are all estimates. So to estimate the interest, all you got to do is take the previous month's balance, multiply by the interest rate, and divide by 12. So equals H2 times 0.1 divided by 12. And why do you divide by 12? Because you get the monthly interest, and interest rates are quoted annually, APR, annual percentage rate, right? And so you divide by 12 to get the monthly interest, and that'll give an estimate for the interest for the month. And then go ahead and sum it up, and we'll have paid $833 to pay off $23,000 of debt, right? $833. Okay. And so if you take a look here, right, um, it should probably just take us about 8 months at the max. Because even if we put this 833 at the end, it's not going to be more than our cash flow. Because then if we say this is 2833, right? Just ignore this part for now. And then we dump our 5,000 minus 2,000, then this is definitely going to be less than 3,000, right? So something to consider that it's going to take approximately about 8 months. Okay. But yeah, I mean, think about this. Who pays off 23,000 debt of 7, 8 months and is able to sleep at night well? I do this all the time because as soon as that paycheck comes in, it's being dumped into the HELOC or line of credit if I have debt. Now, here's the thing. Let's say I'm at this point where I have zero debt, right? Then you'll have actual real cash flow because once that debt is paid off, then you're going to have $3,000 and then next month, $6,000, $9,000 in your checking savings, right? And the beauty of it is you're not going to be in the situation where let's say you have $15,000 in your paycheck and checking and savings and then $15,000 in credit card debt or loans, right? Or where you're making 0.001% interest and you have a 6% loan or 20, 30% credit card for that same amount. You don't want to do that, right? Right. So this is Velocity Banking at 4 a.m. We start at 4 a.m. So if you're part of the hardcore group that's doing this at 4 a.m., congratulations to you because you'll certainly have mastered this 4 a.m. boot camp. I gotta make a emoji or something and get someone on Fiverr to make me like a 4 a.m. boot camp sticker, or maybe who knows? Maybe I'll just do 4 a.m. streams or something like that just to see who's really dedicated. No, I'm just kidding. All right. So this is Korean Atlanta Mentorship. If you're interested in learning about velocity banking, real estate investment, or general financial education, or anything I talk about on this channel, go ahead and click the Google form link below. Submit your information. We'll get a one-on-one Zoom call. All right. Have a great day, everybody, and we will speak next time.